I'm Antoinette Rodriguez, CEO of MarFi Advisors in New York City. We are a strategic marketing and business building, as well as a fintech consulting firm to financial advisors and the wealth management industry. My background is in VC and technology back in the days before 9/11 in a Tampa Bay technology firm. I'm one of the co-founders of that, which is one of the largest tech organizations in the country right now. So shout out to my people in Tampa Bay. I wanted to first introduce or discuss our four esteemed panelists today, and Carlos is offline, but let's talk first about Ron DeBari, who is the Executive Chairman, Chief Investment Officer, and co-founder at NewOak. Perri Richman, who is zooming in from New Jersey, CEO and founder of Inspire Global Ventures and the JASP tech platform. Carlos Zalles, I believe I'm pronouncing that correct. If my Puerto Rican mother would be proud of me. Streaming in from Miami, chairman and founder of LW Partners. And to my left here is Alex Koles, founder and managing director of Evolve Capital Partners here in New York City. I wanted to first give each speaker an opportunity to briefly discuss their background and current investment and or fintech related focus. So Perri, let's start with you.
Wow, go to the phones. Thank you so much for having me remotely. I'm Perri Richman. My background is in strategy, and I use technology and advisory services to bridge organizations with early stage and private placement companies for investment and for innovation. My technology platform, Antoinette, as you had referenced, is JASP. It's a wealth technology platform designed to integrate into a family office technology stack and really simplify and streamline early stage or private placement, investment, communication amongst family members and advisors and whatnot, and essentially bring both intelligence and productivity to the process. So I'll just end with my voice, and my focus today really stems with trends in fintech that help really address how we bridge the gap between generations as wealth moves from one generation to the next.
Thank you, Perri. I have a great follow-up question on that.
Awesome.
Next, okay. Ron.
Great. First of all, thank you for moderating the panel. Thanks to Marty to putting this. I thought it was techie, but maybe not enough. And thanks to Marty to put in this great program. I think I attend many of these type of events, and frankly, I find this format one of the best in terms of communication and bringing people together. Background-wise, until 2008, I was entrepreneur, first in aerospace and then in financial engineering, and then an entity that became BlackRock and moved in there. So technology was always a must, but ultimately the thinking and the fundamental behind everything would be the driver. So the technology was enabler, both in when I was in aerospace, when we were running large operations, new designs. In finance, the same thing. Actually, I entered the industry in 1994, where the industry was a bit in a chaos format because you had, you had BlackRocks of the world who have just entered the market and trying to really revive them, but you still had the old timers that like to conduct business on the golf course, as far as managing things. So. All along, the philosophy has been fundamental, quantitatively assisted, fundamentally driven, but ultimately came down to human in the flow using technology, whether we were running liquid portfolios, illiquid portfolios, or private investing. 2008, I made a decision that copy BlackRock's ideas in terms of whatever they've done in the liquid market, which is really essentially creating a full information connectivity, even with their investors, and internally an operation, bring that into the private investment. And there it is, the fintech into a very specific narrow area, which I call B2B2C. Even though, it's narrow, but embedded finance is making it extremely a wide ocean of opportunities that are not necessarily available currently if I had gone into a liquid market. So that's what we focus on. And we are both venture asset manager, advisor. Our advisory is primarily on illiquid assets, complex, and from the government all the way to some of the largest banks and sovereign wealth funds and regulators. But on the venture side, we have essentially rotated all our own capital back into what we call NewOak finance. So with that, I will pass it on to the next person.
Carlos?
Hi, sorry, I had a little bit of trouble logging in, but I finally, Marty came to the rescue, and I'm happy to be as part of the panel. Thank you, Marty, again, for inviting me to this very interesting conferences that you organize. And thank you, Antoinette, also for moderating the panel. I'm Carlos Saez. I'm CEO and founder of LW Partners Group. We're a group of financial service companies focused on Latin America. Really, we have three fundamental areas of business: corporate finance and investment banking. We have wealth management and asset management. The firm runs approximately about $400 million in assets under management, pretty much focused in the region. And we're also quite active in the fintech space. We've made a couple of investments and have advised a number of companies. And I'll be talking a little bit more about that as we get into that topic. We have several, I'll finish off saying that we have several offices in Latin America, particularly Argentina, Peru, Ecuador, Panama, Mexico, and Venezuela, just by virtue of the fact that the company was founded there. We have no relationships at all with the government.
Gracias, Carlos. And I'm turning over to Alex.
Thanks. Hi, I'm Alex Koles. I'm the founder and managing director of Evolve Capital. We're a New York-based boutique investment bank. We focus on companies at the intersection of financial services and technology. Really, the three core verticals we focus on are insurance, capital markets, and lending businesses, so service and software companies in and around those spaces. So it's kind of fintech-ish at the end of the day. A lot of our clients are really truly tech-enabled service companies. And as the gentleman over here said, embedded finance is a very important part of a lot of our clients because they consume data, analytics, different kinds of software packages to make their business more efficient in terms of how they service capital markets participants. So, typically we're only working with entrepreneurial-run businesses. Enterprise value is about 50 to 75 million and above. They're usually selling their business or doing a growth equity raise. So we package the companies up and sell them to businesses such as Refinity, who we transacted with. Genpact is an old client of mine. We sold a business to Strauss Zelnick, which is a PE. He runs a PE fund. We also are doing a lot of work in the insurance services and technology space as well. So it's interesting to see fintech, or what you call it, kind of crossing across all of these three areas. So kind of excited to speak about it. So I'm excited to come out and do a presentation and talk to people. We've been so busy. It's not been funny. Thank you.
Good problems to have.
Yeah.
So the first question didn't quite get as much votes as Beyonce, but did receive most upvotes by our panelists in our Zoom brainstorming prep. Which specific fintech sectors or applications do you feel have the most significant potential for disruptive industry impact in 2022 and beyond? And I'd like to give Ron the first shot at giving us some insights.
Thank you so much. Well, I think what is important is data. Obviously, it starts off from data. You're not collecting data. You're not really starting with anything. So data has got the number one. The industry that we think is new and very impactful in a real way is marrying embedded finance and ESG. And I think if you listen to even Larry Fink, he knows that this is an opportunity of lifetime, if not opportunity that has never faced it's on planet Earth, if you will. And what is important that is in this arena is that collection of data can be done at the point of transaction. It could be done behind the scene, and about 80% or 90% of these companies are not public. They're private. So getting that data, being able to create it, and building a value chain, which is not just dollars, it's really education, it becomes doing good, and in the meanwhile, you're using money to ultimately to monetize it or to effectively harvest it. So that's where we think is going to be the opportunity, and that's really where I spend my day and night to really think about how do you deliver that, because there are a lot of components, you can blend them together, but you got to start from the data, and that data and how you transform that data to a aha moment that somebody like Siemens or somebody like GE, somebody says, oh, or a defense contractor or a general or government would take a look at it and say, I need to have this. That's how I'm going to, otherwise it's going to cost me a lot to be able to cover my sins. So that's where we think the opportunity is.
Thank you. Perri?
Ron, you stole my thunder for sure. That's absolutely where I would go in terms of embedded finance and ESG at various points in the value chain, whether it's helping investors make better decisions as it relates to ESG principles embedded inside of a business, or if it is consumer-driven technologies. I met with a fintech founder just yesterday who has a point of sale ESG calculator where you're able to calculate on the spot what type of social or environmental impact your product purchase has and be able to calculate that out. It's a corporate proposition as well, because a corporate is able to see what that spend impact is and what their consumers are really looking for and how they're purchasing. So I agree. Data is absolutely critical in this space. Consistency of data across platform, given that there aren't necessarily consistent ESG standards. And then, of course, there's questions about how we encourage private placement companies to release their data, even if it's not where they want it to be.
Thank you, Perri. And back to Alex.
Yes, thank you. Yes, a couple of things. So Perri, you make a great point. The consistency of data is insanely important. I'm not going to touch as much on ESG, but one of our prior clients is a business called FinMesa based up in Boston. They are an investment analytics engine, really a financial calculator. They do about 1,400 different types of calculations for large portfolios. They sell it with TD and Ameritrade and the likes. But consistency of data is, like you said, it's so important because there are so many different data sources, different types of data feeds. There are almost too many data companies. So again, the quality of the data is extremely important. Also, Ron had mentioned that 80–90% of the companies in the space are private. I'd almost venture to say it's 95% if you look at it at the count of businesses. If you're looking at it from an investor or an acquirer standpoint, it's a highly fragmented space. We see a lot of kind of smaller businesses trying to tackle niche applications such as providing data for income verification or providing data to help verify income for your credit card, stuff like that. Companies tackling small parts of the value chain. We do think at the end of the day, there'll be a big consolidation play just because of, there's so many different kinds of providers. So again, data, embedded finance, it's here to stay. We don't advise as many of those types of companies, but a lot of our clients are consumers of these services, and it makes a big impact on their business in terms of how they run and operate and become more efficient. So again, great comments from you guys there. So that's kind of our spiel, as it relates to data and what this panel is saying out there. Thanks.
Thank you. Carlos?
Yeah, as I mentioned before, we're very much Latin focused, and we believe that the Latin American fintech still has a long way to go. A global fintech in financing in 2021 was up 168, whereas in Latin America it was up 269%. So that shows that there's an emerging trend towards Latin American companies. There are very few fintechs that have gone towards IPO. They've been mostly companies from Brazil. So I think there's still a huge opportunity in countries like Mexico and other areas in the region. And I would say particularly Mexico and possibly Argentina also. The Latin American market is very under-digitalized. About 30% of the population, 15 years or older, have access to bank accounts. So that opens up a huge market for all the, potential users of financial services in the region, just to be able to have an account, to be able to make payments and receive money. And that's compares to 90% in the developed world in countries such as the UK, US, and Spain, and 80% in China. So there's still a lot of room to grow in that particular market. So I believe in the fintech space in Latin America, and I also believe that there's the whole process of decentralized finance. I think that's going to become a very interesting topic for companies to be able to fund themselves going forward. And we're seeing some activity in that sector already. And I think probably that's going to be an alternate source of funding for these types of companies also.
Thank you. Also, this next question, I think Alex would probably be good to lead us on this one. Please give us a case study of a deal you have worked on.
Sure, absolutely. So one of the themes I wanted to bring into this panel is the impact of regulation on companies participating in the financial services space. As you know, the regulatory burdens, if you're an insurance carrier, bank, capital markets business, is very high compared to other industries. So a transaction we're currently live on right now, that'll consummate sometime in Q2, is a consumer collections business. It's one of the more sizable independents out there. And you might find this to be kind of a boring, esoteric corner of the market. But what this company faces is very, it happens to a lot of our clients in the financial services space. They're audited. They have regulatory bodies crawling over them on a regular basis. They have, very large clients. They have top banks. They have top telecom firms. They have top fintech lenders as their clients. Fortune 200 businesses. So they're under a lot of pressure. Okay, and then in the consumer collection space, you can't call people as much as you used to. Okay, so how do you get to folks? How do you get to the debtor? How do you act nice to the debtor? Texting, email, stuff of that nature. Having a good website is 30 years ago in Facebook land, but in corners of the financial services space, it is new. So looking at them, and I'll go on one other area. They are consumers of a fair amount of reg tech, but they're also consumers of a lot of workflow processes, and they have to document everything. And they have to get ahead of any potential regulatory issues. So technology has enabled them. Regulation is something they stay on top of and get ahead of. And I think for a tech company in the financial services space, if they ignore regulatory burden, state, local, or federal, I'll go into it, they'll probably get the book thrown at them more so today than in the past. And our clients, we have to get them ready to go through this transaction. And a deal we just completed, about a $250 million M&A transaction. The buyer was very focused on FTC issues around claims, advertising claims made by the company. I mean, it was, we had the former general counsel of the FTC on the opposing side grilling us on diligence. It is very important. So I just want fintechs to realize this is an issue that they have to get ahead of. If they don't, they're going to face penalties and fines. And regulation is not there to necessarily make more work, but is there to protect the consumer or businesses for a reason. And if they work in conjunction in that ecosystem, they're successful. So well, I see that in our clients, and I'll go on and on about this for hours, but there you go.
Thank you, Alex. And just as an aside, when I was a wealth manager at Merrill Lynch in the former Royal headquarters downtown, I recall when we first started, they told us that there was a 90% agreement on one thing among the American public, and that was the do not call list. So to Alex's point, I believe it's a regulation. We have to watch that. Next to Ron.
Thank you so much. I mean, I think Alex really hit it very much in the nose, and he made my case a little bit easier to explain. So in 2017, I got on this bandwagon. Before that, majority of our fintech was really related to creating a company called NewOak Branch Advisory. Primarily, it came from a litigation settlement and reps and warranties post-credit crisis. So we were hired by every single law firm in New York City that worked for the banks in order to be able to create proper defense around reps and warranty on the products that they issued, back from 2000 to 2008. That pretty much opened our eyes on how things can get really messed up when you're trying to recreate the past in the future. And really a lot of that evidence was not readily available, and the people who were doing these cases were not the guys who really initially done it, so there was the knowledge gap. And it created a very good opportunity for us to create what, with software, human in the flow, ability and a see-through, that process when it goes all the way to the judge, they would be able to take that. But that was just the tip of the iceberg for us, that there is a huge opportunity in consumer finance. And there were very few finance companies that could be what I consider instantly audited. From the advertising, it was said, from their underwriting, from when the actually person hits the button and say, I want to take this credit, and from further the collection side. And also the internal workflow processes in terms of really creating good financials and transparency so that the big banks can actually give you capacity to utilize the money. So that really led to what we have is, I think, very unique. FuturePay is the only revolving credit that is not using Visa, MasterCard, and all the interchanges that you're all used to. And it's a non-bin card, but it does use a bank underneath. But everything that is done is really truly digital process automation. So really with the less than 10 people, you can run it, but you do need the best, is what I consider chief of compliance, because to put that document together, we probably spent about $2.5 million. To start it with, we already had a set of documents, but to bring it to the level where a bank would let us essentially drive and just show up every quarter that we've done correctly, and they're not on the hook. So the next thing was that we addressed the merchants, we connected the consumer. The next one was, how do I expand it to the employers? It was very natural for us to get to early wage access, which was, again, not a lending product. That is not a lending product, it's primarily an advance. And how do we actually move that? So once you got the employers, you got the consumer, and you got the employees, the world becomes your oyster. And now that's the extension of that, and that's NewOak Finance with FuturePay and OrbisPay. And that's been something that it really been a journey for us to get where we are now. And then we're expanding to ESG and providing products to 10 kids from 9 years to 19 years. How do they measure their spending pattern and also learn from that in the process? They're essentially training themselves to learn about the science of how we are impacting our planet Earth. And that's, I think, is something that we've found that the parents are interested, financial institutions are interested, and we're teaming up with the people who can provide us that reliable data to put it in the loop. That's really the journey that I think is going to be, at least for 10, 15 years, for us to complete.
Thank you, Ron, and we'll be talking a little bit about the generational aspects in a few moments. Let's go ahead and move it over to Carlos, please.
Yeah, thank you. We have, I think, a very successful story that we can share with all of you. Approximately 2 years ago, since our firm is involved in financial services, we had been looking for an opportunity to invest in a fintech, and we were introduced to a company called Fondadora. Fondadora is a challenger bank based in Mexico, and when we invested, a little over 2 years, was it, I think, November of 2019, they had 10,000 users. In the last 2 years, they have grown exponentially, and today they have about 430,000 users. And this goes back to what I was saying earlier in terms of the great level of underpenetration of digitalization in the region. For a company of this stage to be able to grow and really not face too many growing pains in the process. And they just raised their Series B approximately 3 months ago at a post-money valuation of $275 million. I think they're well on their way to becoming a unicorn in the region. And the most interesting thing, which I think was one of the points and one of the questions that I think, Antoinette, you had to raise, is that the lead investor in the first Series A that they did, we went into the seed round. Then they did, Y Combinator came in shortly thereafter, and Y Combinator introduced them to a group of very large investors. And the Series A round was led by Gradient. So Gradient today is the largest investor, which is interesting to see that an artificial intelligence unit of Google is going into Latin America via a challenger bank. I think the other interesting factor of this company is that they own a banking license under what are called the SOFIPOS, under the Mexican fintech laws. So they're well structured to be able to continue growing, to be able to provide services to their 400,000 plus users. Their goal is to go to 1 million users over the next 9 to 12 months, and eventually maybe go to an IPO. They have focused mostly on payments. They have not gone into the credit space. I think very wisely, they were very cautious in terms of going into the credit space. There's been a lot of issues in Mexico. I don't know if you've read, SoftBank invested $100 million in a company called Alza, only to find out a year or a year and a half later that the accounting that Alza was carrying was not particularly kosher, and basically they whacked out $100 million out of their investment in Alza. Recently, there's been another payroll lender called Crédito Real, which defaulted on a bond last week, and bonds a month ago were trading at 90 cents. Today they're trading at 20. So the whole credit space has been rocked quite a bit because of this, and I think Fondadora, seeing that this potentially could happen, was very cautious in terms of how they would proceed on credit. And they have now finally come to the realization that they're going to go into the buy now, pay later program that most of the fintechs that are involved in credit are doing. But this time around, the advice has been from Square. Square the founder of Square is an investor in Fondadora, and they have advised the company on how to properly manage credit risk. I think they're going to be doing very small credits. They're going to be doing overdrafts as a first stage, which is something that in Mexico doesn't exist. There's a fair amount of resistance that you can well imagine from the large institutional, well-established banks in Mexico, particularly the Mexicans. But I think because of the strength of their shareholders, they've been able to move along and continue to grow, notwithstanding pressure that's been put through the regulator, we believe enforced in a way or led in a way by some of the large Mexican banks that are trying to put hurdles to the growth that this company is having. So we believe that this is an example of probably many others that are going to be that we're going to be seeing in the region, because of the fact that the region continues to be very, very underserved, and large portions of the population do not have access to a banking product.
Thank you, Carlos. And actually, the next question I'm going to ask you to elaborate on that. Perri, please.
Sure. I'm going to stay in the early stage space and also pull on Ron's language of eye-opener. And remember, I come from the Fintech platform foundership. So forgive my case study being one of my own. As I mentioned, JASP is a platform that does aggregate data and news from a variety of outstanding data partners and sources and matches it with business productivity tools to help investors make better and faster decisions about early stage investments. We worked with one of our clients, Framework ESG, which is a sizable yet boutique ESG consulting firm, to design and indicate the leading indicators of whether or not ESG is built into a private placement company's business model. It's not meant to replace a reporting framework, but it is the top 5 indicators for strategy, environmental, social, and governance. And an investor can look at an individual company or can look across their portfolio to see how well ESG principles are embedded. We sat down with an investment group. We added their portfolio companies into JASP, and they had been looking at what kind of ESG positioning they could go out with as they went and fundraised. They were also looking at ways to differentiate their portfolio and their investment criteria. And in looking across their portfolio at the key leading indicators, there was a recognition or an eye-opener of the fact that, maybe some of these companies don't really have the principles truly embedded into the way that they operate. So the result was a new way of looking at a pipeline and having new indicators to be able to look at and evaluate and measure progress against within an investment portfolio.
Wow, thank you, Perri. Now for the third question, for any of you, and I'm talking to people in the audience here as well, if you've been to a restaurant in New York City recently, one of the things that maybe I shouldn't be surprised by is that when you walk in, besides showing your vaccination status, which is all by cell phone, and by the way, always charge your cell phone before heading to a Broadway show that requires vaccination, especially those hard to get tickets at Hamilton. So if you go into a restaurant today, one of the things that I have been surprised by is that you don't get a normal menu anymore, right? So all QR codes, and everything from the order to the payment is digital. Now, for people outside of this country, this might not be an entirely unusual thing. So on that point, the question is, do you believe the pandemic has affected the evolution and acceptance of fintech solutions, and how? And given his international focus, Carlos, vamos a empezar contigo para esta pregunta.
¿En español te respondo?
No, en inglés, por favor.
We've got a pretty broad network of people who watch these videos.
Yeah, no, just
The thing is Google Translator.
Well, I think it's been definitely a game changer. And again, because of the simplicity that the whole app process of opening accounts was brought to the user. We've seen many cases of institutions that can open a bank account in 2 hours. And the next day you receive a debit card from MasterCard. And that we've seen that in Fondadora, we've seen in other, because in addition to having made an investment from a company standpoint and from a partner standpoint, we also brought in clients to invest in this particular case that we discussed. But we've also had other investments. We invested in a digital wallet that's developing an app for remittances. So I think the pandemic has just sort of simplified the process for inclusion of minorities into the financial world. So I think definitely it's been very much a game changer. And I think we'll continue to do so. If you try to go to a bank to open an account, it's going to take you 2 days, in the best of cases. And in Latin America, it can take you a week. So when you have it, through your app, you could open a bank account in 2 hours, and they have pretty sophisticated pretty sophisticated compliance mechanisms to make sure that they don't obviously open accounts to people that they don't want to open accounts to. So, so definitely the bottom line is yes, it's been a game changer and it's here to stay.
Thank you. Ron?
Sure. Well, let me start. How many of you guys got checks from IRS or from US Treasury during COVID?
I don't get checks from the government, unfortunately.
You did not get the $2,000. I thought the majority of people do.
Well, I mean, depending on your level of wealth, you actually don't get a payment.
Right.
Oh, really?
Yeah.
Oh, I got a mistake, but the bottom line is that the U.S. Treasury was having difficulty to, they had to send checks. They did not have the mechanism in place to be able to put this money in people's accounts instantly. So, but they're looking for that solution today because they know that that money transfer, being able to make sure the money is going to the right person is there, and that's one simple change in our government system as a whole. I think you're going to see that every single government agency is looking for proper payment system with their own employees or proper communication system so they can work remotely. So those are some of that elements related to that. We happen to work for a company that launched in 2017 in training. They thought the entire market was going to be more corporate training. They were very surprised that one of the biggest adapters ended up being universities, private universities. Of all places, in places like India and Middle East, they became the largest market. They went from effectively zero to $300 million a year just during the COVID. And I don't think that would have been there if the COVID did not happen and people were not trying to deliver education, but also deal with the fact that people are no longer in the classroom. How do you create an AI-based and customized training and attract people to give you $20,000, $30,000, $40,000 a year tuition if you want? So those are some of the examples of a whole new areas popped up that ultimately ended up requiring finance because those students do need the tools. They need to even finance their own participation in these educational stuff. So again, there are many, many, many examples of how essentially COVID accelerated fintech. And fintech also went from just being payment transfer, now it became really data lakes and AI and really getting a full digital process automation, embedded BI, which is business intelligence, away from just, that's called cheating. BI is cheating, AI is predicting the future. So if you can really cheat and you're not cheating, you're even worse than the worst student. So those are some of the examples that we use those in terms of shaping our business to figure out how do we go where the hockey puck is going to be, not where it is today.
Thank you. Perri?
Sure. So, I mean, the obvious answer obviously is the acceleration of payments, as well as the greater emphasis as it relates to crypto and blockchain. I'd say the two lesser items that come to mind, one is around operational resilience in fintech as it relates to cybersecurity, operational a certain level of resilience and protection so that those, financial critical employees are able to safely and securely work remotely. So any of that back-end technology to protect and make companies themselves more productive and streamlined has definitely emerged in the midst of the pandemic. And then going and leaning toward what Carlos was saying, the pandemic itself has shown a light on inequality and the need for, obviously reduced inequalities. So the amount of technology fintech alone as it relates to not only banking services for individuals, but banking services for the, massive amounts of minority-owned businesses that have popped up, both Main Street and growth businesses during the pandemic. So those technologies that are helping to accelerate investment in minority-owned businesses in particular are also something that's absolutely accelerated.
Thank you, Perri. Alex?
Sure thing. I think the panel touched on a lot of relevant issues that we see from our clients and our investor and acquirer base. So first off, neobanks, absolutely, in some aspects transformative, especially in Latin America, but also the Southeast Asia region. So we advised a company called MatchMove. They are a banking as a service business out of Singapore on a transaction, and they were experiencing, probably as you are, Carlos, seeing from some of your opportunities, just massive growth because it's underbanked. Like Indonesia has 300 million people crammed into a small sized island. A lot of them don't have access to traditional services. MatchMove, speaking to payments, would push out government remittances through the MatchMove platform on the prepaid cards. So those kinds of technologies became more prevalent during the pandemic. Because we do work in the insurance space, InsurTech, is it FinTech? I don't know. I'll throw it into the same area. But we have a company in the South today. They are one of the nation's leading or largest independent claims businesses focused on flood independent adjusting and examination services. When a claim happens at your house that requires people to come visit, COVID, people became skittish. So claims processes became more mobile focused, and also they started using drones. So you're seeing, at least in the InsurTech or insurance side, quite frankly, even more than in the fintech space, much more crazy capital chasing businesses there to drive solutions. And the last person said digital transformation, because we focus on B2B businesses. It's happening everywhere. So I expect that trend to for sure continue. But for COVID, it just pulled forward what's going to happen probably by a few years.
Thank you, Alex.
Yep.
So when I was reviewing the agenda, the two-day forum agenda, I asked my 16-year-old daughter, Sophia, who attends an art school in Brooklyn Heights, if she knew anything about NFTs or crypto. And if you have a teenage daughter or been around one, you know the eye roll and the exasperation it gives to parents, and pretty much every questions were, especially on this one. So she looked at me incredulously and she said, "Mom, of course. At school, in physics class, we talk about crypto all the time." And she emphasized all the time to make me feel particularly inept, right? So this leads me to the next question. How do you feel demographic changes, such as women, multicultural, millennials, zillennials, Generation X, are affecting decisions related to fintech? And given her expertise and focus, I'd like to turn it over first to Perri.
Well, we know that ultimately the largest transfer of wealth is emerging now and continuing to emerge continuing to mature over the next 10 years between boomers and Gen Z, millennials, and even to some extent Gen X. And the values between generations, especially as it relates to investments, aren't necessarily fully aligned. And we know that younger generations are willing to take greater risks. They are willing to invest in businesses that they truly believe in. They are looking for different levels of return. Patient capital is a big thing for a younger generation. And there are groups popping up like Gen Z VC, which is a an incredibly active Slack group of Gen Z and millennial investors who were talking about their financial services companies, how to invest, what to invest in, et cetera. So, you know, the values and what a younger generation of investors is looking for, it is less traditional than previous generations. So there is a pattern there. In addition, we know that women are increasingly becoming or have become greater decision makers in investment related processes. So there is absolute work to do to empower women as they make decisions about how and where to invest, whether private placement or in the public markets. And of course, as this emphasis as it relates to the closure of the wealth gap, and as we get more minorities into home ownership and we're able to see you know, the growth of wealth and the growth of entrepreneurship, we're going to continue to see investments and even greater risk taking in terms of both innovation as well as returning the investment into the community in a benevolent way.
We have about 10 minutes left for the panel. Keep on going.
All right, thank you. And in fact, there was an article specific to family office this morning about this. Ron.
Thank you so much. I think you covered quite a bit on that, on the investment side, but also I think, you know, fintech is definitely a level playing field maker, meaning that there are, you know, I'm just looking at operationally NewOak Finance itself. You know, we start the day in Nepal and we end, you know, the day really ultimately in Hawaii. So just take it from one end to the other. And so that had really made our ability to be able to resource talent, whether you know they're here or they're somewhere else, and bring them in really under one roof, truly under one roof culturally. You know, was not necessarily something I would have contemplated in 2017. As a matter of fact, I went long 20,000 square feet of prime real estate in New York and spent about $3 million to make the best working area right in 2017, and 2019 I handed it back because I know that just part of it was the awareness I ended up getting that I could operate, you know, in 2020, you know, at a much better pool of talent, frankly, a lot less entitled, and be able to, you know, essentially bring them together, male or female. And I think the fintech itself and also ability opportunities it provides to, you know, I think diverse pool of talent is incredible. My head of sales is actually, you know, somebody who was not born here, speak, you know, perfect Spanish and English, and my best digital, I'm sorry, the BDR, business development person, sits in Islamabad, speaks English with an English accent, and, you know, I wouldn't be able to even have him, sponsor him to come here because he won't want to, or she. Our marketing department is not here in Islamabad, of all places. The guys who are actually putting content together. You'd be surprised. So I think you're going to find a whole new world in the next, you know, and this trend was there. The bigger companies were having physical locations in let's say Gorgon, or but that has really expanded the opportunity where you can find really talent and be able to work with. I can personally connect with my person in Pakistan at 3 a.m. between, you know, waking up and going back to bed, and have a 5-minute conversation with somebody, and makes them extremely happy that, wow, they can actually communicate. And I don't think that was ever something that we would have imagined back, you know, in my old days at BlackRock or something like that. You had to get a lot of appointments to talk to somebody to even express your level of discomfort. So anyways,
I just want to say, it's just remarkable the optionality that people have today, because not only is there, AI and tremendous data, alternative data aspects, and you can literally scan all of Google and get to data pretty quickly from it. So anything on the internet you can get to pretty quickly. But also there's this aspect that was brought up by Ron of just being able to offshore and grab talent at a very reasonable price with people who are MBAs from the top schools in their countries, whether it's IIT or Indian Institute of Management or Philippines or Ukraine, Croatia. They're all there, and you can grab extremely talented people pretty quickly who can get stuff done. Or whether they're in Lima, Peru, which has some fantastic universities, right? So, yeah.
Fantastic. Carlos?
Well, I don't have a whole lot to add to. I think what Perri hit it on the right on the nose there with regards to inclusion. And clearly we're seeing, and I go back to what I said earlier with regards to the decentralized finance world. We just teamed up and did a strategic partnership with a group called Securitize. They are a SEC regulated broker dealer whose focus is going to be to tokenize transactions. They've also created an alternate trading system. Morgan Stanley put in $50 million of their own capital into this firm. And they just acquired a new company, so they have approximately 1.4 million users. And in talking to them and getting to know them better in terms of what kind of products should we bring into their platform, they're not interested in the plain vanilla, corporate bonds at ridiculous yields. They want the juicy stuff. And these are going to be millennials, Gen Z, all the young crowd that's made money trading cryptos, and over the past 2 years, maybe not in the last month, but certainly in the past 2 years, I mean, the stock market's been pretty rewarding for investors. So I think a lot of investors, and I'm seeing it in friends of my kids and what have you, that made money, and my own kids really, they all are equity investors. They don't buy bonds, they buy equities. And they've done really well on that, and now they have a different sense of risk in terms of what they want to do and how they want to invest their money. So you have a lot of really young, mid-20s to early 30s that have a lot of money, and they're looking for juicy transactions. So I definitely think that's why you're seeing such a surge in NFTs. You're seeing such a surge in all sorts of alternate investments. I'll give you an example. For example, we're raising money for a fund that's going to invest in buying soccer cards. The card market in general has been very hot, as you may know. It's had some volatility, but they have the World Cup coming up towards the end of the year, and we're going to tokenize it. We're going to basically raise the money through the tokens. So there's a huge opportunity, I believe, in the decentralized world that will bring even further inclusion. And diversification of the way people manage their own money. And I also agree that the women are becoming a more and more important force. You're seeing it in major corporations. Citibank is now the CEO is a woman. She lived in Miami. She was head of Latin America for Citibank here. And you're seeing more and more companies hiring women to become CEOs or CFOs or chief investment officers. So I think the potential is still there and growing.
Hey, Koles, I'm going to jump in here. I'm sorry about that. But just real quickly, can you talk about, you're talking about DeFi, and obviously there's a big movement in the unbanked and, what I always call greenfields, Fintech, people just like not served at all. Like I was in Peru 5 years ago, and it was Friday, and there was literally a line 2 to 3 blocks long of people trying to cash their paychecks, right? Another example is that whenever I used to go to South America, I'd have to hire a driver. But now that Uber's there, they just do it and they automatically transfer payment. I don't have to pay the driver any cash. Uber does it, right? So there's all these opportunities that people don't see, and you're like on ground zero of that, right? But can you talk about devaluation and that impact on why people move to DeFi and are looking at alternative ways to bank and store their capital?
Well, I think the valuation is a key metric, obviously, to follow. What we're also seeing is that companies have unrealistic expectations of valuations of what their company is worth. And they do a family and friends round, and through the family and friends, they're able to convince them to come in at steep valuations. But when you go into the institutional world, the first question is going to be, one, how much money have the founders put in, and two, what kind of valuation are you putting your company, and why? Because we're seeing companies that put $10, $12 million valuations on just a project, so that's not going to fly. So I think in the DeFi world is not going to really shift the valuation parameters, because I think a lot of the investors that are going to be involved in tokenizing are going to be fairly sophisticated investors.
Carlos, let me stop you there. Carlos, I got to stop you. I'm talking about currency devaluations. I think Peru has gone through like the Sole. Argentina's gone through 5 devaluations in the last 20 years, right? Venezuela went through a tremendous hyperinflation. I mean, everybody in South America has experienced this. So people are really looking to move to alternatives to escape it, right? Is that correct? I mean, Ecuador doesn't have a currency anymore, right?
Ecuador, El Salvador are dollarized, and Venezuela is pretty much a dollarized economy right now. So I think you may see more countries moving into that. But you're also seeing a trend in Latin America towards moving towards the left. So you saw it in Chile, Argentina. I don't know how long in Argentina they're going to be in power, but devaluation is always a risk. And that's but I think also people are becoming more sophisticated investors that are moving away to, or looking to hedge by investing in these kind of companies, or in other instruments, alternative instruments that are going to protect them from violation of their home countries.
As a store of value, that I agree with that, but when you're getting paid in local currency and those are not being adjusted on an annual basis, you do create a major gap. I mean, you look at Turkey, has gone a tremendous, and Turkey is a very good example of a country that sells arms to Ukraine, the drones in Ukraine. So they're technologically very advanced. They have very, very German technology in Turkey, but you still have the pain that the currency devaluation has gone, I think per unit was about 4, and now it's in the 10 or 15 range. That really devastated, a huge, government employees, teachers, all across. So, yeah, they whatever money they have, they end up putting in essentially on crypto and other things to protect themselves. In Turkey, you happen to have ability to have dollar or hard currency bank accounts in a regular bank, but this currency volatility is going to bring a lot of questions in terms of the monetary policies of many of these countries. They're going to have to ultimately adopt something different than something that they can control.
We have about a minute or two left. Can we get to wrap up statements and like what people should be thinking about as they leave this panel?
Okay.
We probably have heard some of my themes. If you're looking at investments in the insurance or capital markets or lending space, be very cognizant of the regulatory matters, especially if you look at DeFi, crypto, stuff like that. Not regulated much here in the States, very regulated in other countries. China just doesn't allow a lot of it. So you got to have a close eye to these matters. Otherwise, as an investor, you can get sideswiped very quick. So that's what I have to say.
Perri?
My perspective is stay really, really close to human behavior and make choices about what consumers, workers, future employees, investors, et cetera, are looking for and how they're currently behaving, and ensure that financial technology is keeping up and or really, really anticipating what's next.
Thank you. Carlos?
Well, I think I've covered on the topics that I think we're very close to and are following. One is obviously fintech in the region and decentralized finance. We expect, it's going to be progressive, but I think that's the way of the future.
Ron?
I think I'm going to go with the tradition of diversify, because fintech, as much opportunity as there are, also there is tremendous possibility of essentially overvaluation at the beginning and then correction later, or expectations that don't materialize. And a lot of these, because the technology has become itself democratized, meaning that you can actually, two kids and, write, code and do a demo for you that's going to really amaze you, doesn't really make that ultimately implementable. I finish off by saying data is not information, information is not wisdom, wisdom is not action, and action is not a yes, and yes is not a satisfaction. A good idea and a good initial position doesn't really ensure final execution. So if you're going to get into the early stage investing in these areas, make sure you've allocated a reasonable percentage of your wealth, meaning 5 to 10, and make sure that that itself is across 5, 10, 15 investments. And hopefully you will have the lottery ticket among that. And that's really ultimately is the lottery ticket. But you can correct that by doing it informed and by aligning yourself. But majority of investments at the very beginning are not really made available to your normal public. So you really do need to figure out whether your channel, wherever that channel is making these things available to you as a regular, a family investor, or even if you're a high net worth within a 5 to 10 million range, you find that Merrill Lynch's of the world are not really giving you. They're giving you what they want to think it's going to be the IPO, but if you get pre-Series A, those type of things are the ones that are really going to make a difference.
Thank you.